I don't have a room for you yet. By 2 o'clock, they tell me. What time do undergraduate classes run through? 12 o'clock? 12:15. If I'd known I could have made it 12:15 to 1:15. Okay, I'm going to get started. I mean, I didn't realize that classes went through 12:15, so I guess people will keep coming in as we go through. And it's going to be webcast anyway, so even if nobody's here, I was planning to give the talk to the camera. It's kind of awkward. I've done it before. It takes a particular skill set to act like there are people there. It took me a while to get used to. I do it in front of my computer all the time now. I talk to my computer because I'm recording. My kids all think I'm crazy. But no. Hey, no. So let's get started. Okay. So let me first list out what I would like you to know on this quiz, what I'm going to be trying to test you on. The first is I'd like you to think about, everybody can hear me? Okay. I'd like you to think about the conflicts of interest that embed the modern corporation, between whom the stockholders and bondholders, stockholders and lenders. Those first 3 sessions were all about how different groups in a company can have very different interests in a company, and they can all push in different directions. So we're going to start with that. Not much in terms of numbers in that section, but understanding how an organization works is critical to corporate finance. So that's the first thing. The second is, if I gave you a regression of returns in a stock against returns in a market index, I need you to be able to take it apart. Take it apart in what sense? I need to be able to tell me what the slope tells me, what the intercept tells me, what the R squared tells me. In other words, tell me what the pieces of the regression tell me about your company, just like we did in class. And third, once you have come up with a beta for your company, I'd like you to dig a little deeper and tell me what the variables are that drive that beta, how the beta will change as the company changes, goes into new businesses. In fact, that's the most critical part of this quiz, is understanding how much control you have in this process and understanding the difference between levered and unlevered betas when you use one as opposed to the other. It's a little confusing when you start because you have all these things coming at you, but hopefully by the end of the next hour you will have at least a working grasp of what's going on. The more you've reviewed already, the more useful this review session will be, which means if you haven't reviewed yet, my suggestion is you go back and re-watch the review session in a couple of days after you've done the quizzes, because it'll actually make more sense if you've actually tried things out. So watch it now. Of course, don't leave right now if you haven't done any review, this is obviously a review of something you haven't done, so it'll be all new. It'll be just another class. So let's start at the beginning. Corporate governance. The only suggestion I have is use common sense. Basically, put yourself, it's a key to understanding corporate governance is to put yourself in the shoes of the different players in this game. So this, if you look at almost every quiz, is the first problem in every quiz. And it usually takes the form of 4 multiple choice questions. It's the only time in this entire class that you're going to get asked multiple choice questions. After this quiz, you're almost never, you might see a little sub part of a question where I ask you a multiple choice question. But I don't like multiple choice questions. I don't like Scantron questions. But this part lends itself best to multiple choice questions. So let's take a couple of examples. And as I reason through it, I want you to think about the reasoning rather than the answer. So don't get too caught up in the answer. Think about the reason. So here's the first, I don't know which quiz this is from. Assume you're currently a stockholder in a firm. So already I've asked you to put yourself in the shoes of the stockholder. Go there and stay there. Your job is to look at this question through the eyes of a stockholder. The firm is being targeted in a leveraged buyout. What does that mean? Somebody's trying to buy the company out by borrowing money. And the management is part of the leveraged buyout. They're doing the buyout from you. Okay? So from the perspective of conflicts of interest between you and management, which of the following would concern you the most? Piece of advice, don't pick multiple answers on multiple choice questions. I want you to pick only one. So that's why I'll say best, most appropriate. So don't give me 4 and say, well, I kind of got the right answer somewhere in there. I don't think you can get away with that in the SAT. You're definitely not going to get away with it here. So pick only one answer. So here are my choices. First, the fact that the company will go private after the transaction. Does it bother you? You collect your cash, you move on. What do you care what happens to the company afterwards? The possibility that the equity investors in the LBO might make huge returns. They're a little envious, but they also have a lot of leverage. That's their problem. The fact that the managers of your firm are also part of the acquiring team. Why?
Because it's like they're trying to get a good price for the company they're paying for, but they're also working for the company that's being acquired, so they should be trying to get a higher
You see what the problem is? The managers are part of the acquiring team. They've been managing your company for the last year, right? So if you want to make your price low, what are you going to start delivering in the year before the acquisition? Lots of bad news. Why? It'll push the price down. It'll make it easier for you to acquire the firm. So the fact that the managers are part of the acquiring team should start to worry you. So that, in fact, was the right answer. The fact that people use a lot of debt, they make a lot of money, that bad things happen after the LBO, none of your problem. Because you're going to collect your money and move on. Second question. This is an efficient market question. It kind of cuts to the heart of what it means when you say a market is efficient. We usually see the stock prices of the target firm in an LBO jump on the announcement of an LBO. So when people say there's going to be a leverage buy, the stock price jumps 11, 12, 15, 21%. Is this evidence that markets are inefficient, markets are efficient, or you cannot tell without more information? You see what I'm asking? In an efficient market, can prices jump around? Let me start with that question. In an efficient market, can the stock price jump? In an efficient market, price reflected value, right? So what am I asking? Can the value of a company jump? Let's say you're a biotechnology company. Your value rests on what? On a drug working its way through the pipeline, right? The FDA says this drug doesn't work. What's going to happen to your value? It's going to collapse. The fact that your price drops 60% when that is announced is not evidence the markets are inefficient. Value can change a lot on news stories. It doesn't always, but just because the price jumps a lot doesn't make markets inefficient. So the answer there is you cannot tell without more information. What information would you need? You need to know what's happening in the LBO. Maybe they plan to change the way this company is run. Maybe the debt in this transaction is increasing value. There might be things happening in the LBO that cause the value to go up. Just because the price jumps on an acquisition or an LBO is not evidence that markets are efficient. So what I'd suggest is go through that first problem in multiple quizzes. In fact, I don't know what your strategy is for working through these quizzes. You might decide to do problem 1 on each quiz for 5 quizzes, then do problem 2 for each quiz. That's one strategy. The other is to do each quiz fully from start to beginning. I'll leave you with that choice. But work through these multiple choice questions, and what I want you to think about is putting yourself in the shoes of whoever is being targeted in the question. In this case, I targeted you as a stockholder in the acquiring company. I could have made you the acquirer. I could have made you the lender to the company. The way you look at the same transaction can be very different depending on whose shoes you're in. Any questions in that first section? Yeah.
So what's the condition for markets to be efficient then? Just
it's very difficult. Price has to be roughly equal to the value. So if you, in fact, you work out the value change and it's roughly equal to the price, well, that's an efficient market. But to do that, you actually have to estimate the value effect of the LBO by working through how the company is going to change after the LBO. Now let's cut to the chase. Let's start with the number section. Yeah.
Sorry, one question on the. So there are a bunch of different scenarios of like, oh, if this is the problem, then.
You have to be more specific. Bunch of different scenarios. This is a problem doesn't help me. So give me an example of what confuses you, and we can deal with it. Right.
I was just wondering, in the different scenarios, what would you want to maximize? Like, as
You're talking about the
opposed to
objective
markets?
function of the firm? Is that the specific question you have?
Yeah,
What's
to like maximize shareholder interests. if you
That's
have-
that's a good question. In fact, let's look at it. There are lots of different objectives you can have as a company. The narrowest is to maximize stock prices. Somebody help me out. What do I need to assume about the world for maximizing stock prices to be the only objective function I need? Markets have to be efficient and bondholders have to be protected. Tell me why the bondholders have to be protected. Because you could rip off your bondholders and make yourself better off, and if I let you do that, then you're really not making the company better off, you're just stealing from the bondholders. So in a world where markets are efficient and bondholders are protected, you can maximize stock price. Now let me take one of those assumptions out. What if markets are not efficient? What have I just said? Then focusing on prices can be dangerous. You can't focus on prices, you have to focus on stockholder wealth, an assessed value rather than the price, because price is not trustworthy. If you maximize stockholder wealth, you're saying markets are not efficient, but bondholders are still protected, so I can still focus on stockholders. What if I take both assumptions out? What if markets are not efficient and bondholders are not protected? Then what do I need to do?
Maximize firm value.
Maximize the value of the business. Those are the only three objectives, right? Maximize stock price, maximize stockholder wealth, maximize firm value. Maximize firm value is the most general because you don't need any assumptions. Maximize stockholder wealth, you need the assumption that bondholders are protected. Maximize stock prices, you need both assumptions to hold. Markets have to be efficient and bondholders have to be protected. Think through the consequences. Again, don't make this a memorization exercise. Just think about what will happen if you focus on an objective and an assumption breaks down. And you can very quickly see why we need these added layers. Help you? Okay.
Yeah.
Any other questions? So now let's turn to the regression. When you run a regression, there are three pieces of output in that regression that you should be looking at. The first is the intercept, the second is the slope, the third is the R-square. What can we read from the intercept? The intercept tells you what your stock actually did during the period of the regression. But to make a judgment on whether that's a good number or a bad number, you have to compare it to what the stock should have done during the regression if it had done exactly as the CAPM. So when you do the risk-free rate times 1 minus beta, here's the way to think about it. That's what the intercept should have been if your stock did exactly as predicted during the regression. So you're comparing what your stock actually does to what you'd have expected to do. The difference is your Jensen's alpha. If the difference is positive, your stock did much better than expected. If it's zero, it did exactly as expected. If it's negative, it did worse than expected. So what I'll do is take an example here and kind of illustrate this. A couple of mechanical details as you do this. When you compare the intercept to the risk-free rate times 1 minus beta, you have to make sure that the time intervals you're using are consistent. So if your returns were based, if your intercept was based on monthly returns, your risk-free rate has to be a monthly risk-free rate. If it's based on weekly returns, it has to be a weekly risk-free rate. If it's daily returns, it has to be a daily risk-free rate. And it's a difference that tells you whether a stock did better or worse than expected. So let's try an example, because then we can do the what-ifs. This was from a few years ago, and I usually, when you read the description of the regression, it'll tell you that I'll make up a name of a stock, obviously. I'll tell you what index I used. And I'll also somewhere in there tell you, so read as you read the regression, what kind of returns I'm using on the regression. And in this case, what am I saying? I'm using monthly returns. So the intercept is going to be a monthly intercept. The monthly intercept is minus 0.20%. Don't freak out yet. You're saying, that's awful, it's negative, stock did worse. We're not quite ready to do that. The beta for the stock is 1.50, the slope of the regression. Let's assume I told you that the Jensen's alpha was 0.10%. Let me go back to this equation. Let's think algebraically. How many terms are in that equation? There's the intercept, there's the risk-free rate, and beta. So let's think of the risk-free rate times 1 minus beta as the second term. And there's the Jensen's alpha. There's one equation and three variables. Algebra 101. If you have one equation, how many unknowns can you have?
One.
One. So no matter how tricky I try to make the problem, I've got to give you two of the variables. So anytime you have a Jensen's alpha problem, what are you looking for? What have I given you? And I have to give you two of the three. So you should feel some sympathy for me. It's very difficult to write tough problems when you have only three variables and I have to give you two. There's nothing really that I can hold back. I can't give you one and say try to guess two. Mathematically that's impossible. So let's take the problem that I just given. Which of the three variables do you know? I've given you the intercept, the beta, and the Jensen's alpha. What do you not know? Risk-free rate. It's an algebra problem. That's all it is. And this is what the algebra problem looks like. There's my Jensen's alpha. There's my intercept. There's the beta. I have one equation, one unknown. You know what this is a test of? Whether you remember algebra. And if you don't remember algebra, I can't help you. Right? You have to remember the order of operation. When you move things around, that negatives become positive. All that stuff you learned in 7th grade, go back and dig it up. Because if you solve for this, the risk-free rate you get on a monthly basis is 0.6%. Why is it monthly? Because I used a monthly Jensen's alpha and a monthly intercept. So I've got a monthly risk-free rate. And let's suppose the problem had asked you for an annualized risk-free rate. What are the two ways you can do it? What's the easy way to do it and what's the complex way to do it? Easy way to do it? Multiply by 12. I'll make a suggestion. You have 2 minutes left on the quiz. You haven't touched an entire problem. My advice is multiply by 12 and go try that problem out. I'd rather that you give me an approximation than struggle for 2 minutes trying the compounding. Because I'd much rather that you try a problem out than leave it behind because you were so busy doing this compounding to get the right risk-free rate. So if I multiply by 12, 12 times 0.6 is 7.2%. I'm done. If I want to do it right, of course, I should be taking 1 plus that 0.6%. And that's why I said don't mess with this unless you feel comfortable with decimals and all the rest of the neat stuff that you need. 0.6% is 1.006. It's 0.6%. It's not 60%, right? Raise to the power 12, because you're going to earn 0.6% every month for 12 months, gives me 7.44%. Here's a simple test. If you decide to compound, always check your compounded answer against just a simple answer. If you get 7.44% as your compounded answer, your simple answer is 7.2%, then your compounded answer is definitely wrong. So just make sure that you're working with numbers. So as I said, in this case, 7.44% is your annualized. Any questions? Let's do one other what if on the problem. The problem I gave you the monthly Jensen's alpha, right? I could have given you the annual Jensen's alpha. In which case, what do you need to do? You need to convert it into a monthly. And here again, there's a shortcut and a long cut. The shortcut is just divide by 12. I'm giving you the annualized number, divide by 12. So if I give you an annualized risk-free rate, that's a quick way to get a monthly risk-free rate. Again, if you want to show me how good you are with compounding, not a problem. Just take 1 plus the annualized number, raise it to the power 112, because you're going from annual to monthly now, and you get 0.0198%. It's like the second decimal point. That's why I'm saying don't make this front and center the only thing you focus on when you think about doing these things. Any questions? So that's the intercept, and that's what you learn from that. Now to get from betas to expected returns, somebody help me out. What do I need? I need a risk-free rate, and I need an equity risk premium. The risk-free rate I use should reflect the currency I make. So in the problem, read the problem carefully, because I'll tell you, do it in pesos, do it in dollars. You can't just pick a currency and say, I got it right in that currency. I don't care. I want it in the currency of my choice. So risk-free rate has to be a default-free long-term rate in the currency of your choice. The equity risk premium has to be a weighted average of where you do business. So if I tell you your company does 60% of its business in Mexico, 40% in the US, you have to take a weighted average. And to get the equity risk premiums for countries, you have to start with an equity risk premium for the US or a mature market. If you don't like the US, you have to give me a base, and you got to build on top of that. How do you build on top of that? You can add a default spread for that country onto that premium. That's a simple way to do it. Or the better way to do it is if I give you the numbers to come up with a relative equity market volatility, how much risk your equities are, you can tell me what that added premium is going to be for a specific country. Again, abstractions don't help. Let me take an example. This was from, again, a few years ago. I gave you a beta regression for Cemex. It's a Mexican cement company. And I've run the regression against the Bolsa, the Mexican index. So there's the regression output, intercept, beta, R squared. Let's assume the beta from the regression is right. The reason I have to say that is it's a Bolsa. You might say, I don't like it, I should run against yes. But for this quiz, this is what I gave you. Assume the beta is right. I want you to try to estimate the cost of equity in Mexican pesos. I've tried to be very helpful by underlining the word Mexican peso so you don't miss it. So already you can see what you need to do. The 10-year Mexican government bond rate is 8.35%. I've given you the government bond rate in pesos. Is that the risk-free rate? Why not? Because read the rest of the program. I say the Mexican government has a local currency rating of AA, which is not AAA, and a default spread of 0.65%. You don't even, for this quiz, you really don't need a calculator if you think about it, right? If I ask you what the risk-free rate in pesos is right now, what is it going to be? 8.35% minus the 0.65%, which is 7.7%. If you need a calculator to do that, go ahead. You know, don't feel there's an urge to show me this. I can do this without a calculator. But you can actually do this. It's not complex. The numbers will not be in the 5th decimal point. So my risk-free rate in pesos is going to be 7.7%. Everyone with me so far? So if you have a currency where the government is not default free, you have to do this. You've got to take the government bond rate and net out the default spread for that government. So I've got a risk-free rate in pesos. What's the second piece of the puzzle? I need an equity risk premium for this company, right? Let's say the risk premium for the US and other mature markets is 4%. That was already given in the prompt. You're saying, what if it's not given in the prompt? Those of you who've actually tried out the older quizzes probably noticed pre-2002, I used to let people look up the premium. You say, what do you mean look it up? It's open book, open notes. You got the historical premium, you got the implied premium, and I would let people look it up. So if you were looking it up right now and you're looking at the historical risk premium page, you'd get 4.54%. I can't fight you and say, that's not the right premium. Pull it right out of my notes. You know why I've started giving mature premiums in the class? It's amazing what people look up in their notes. They look up page numbers. I get equity risk premiums of 281. There's a page number to the equity. So you're in a hurry, you just pull numbers off the page, wrong pages. It makes my grading of these quizzes a nightmare. So starting in 2002, I've always either given you the numbers to get to the mature market premium or given you the mature market premium already. In this case, I've given you the mature market premium. And I've also told you Mexican equities are 3 times more volatile than the Mexican government bond. Why is that going to come in? To get the equity risk premium for Mexico, here's what I did. I took this 0.65%, the default spread that you saw from the previous page. I multiplied by 3. Why? Because if equities are 3 times riskier than the bond, the premium on equity should be 3 times higher. My equity risk premium for Mexico is therefore going to be 5.95%, the 4% plus the 1.95%. And in this case, because I have all the numbers, risk-free rate, beta, and risk premium, the cost of equity I get in peso terms is 14.13%. Let me ask you a question. How would your answer have been different if I'd asked you for a cost of equity in US dollar terms? What would you have done differently in this equation? Would your beta be different? No, beta is beta. It's a relative. Would your equity risk premium be different? It shouldn't be. It's over and above your risk-free rate. What's the only number that's going to change? My risk-free rate will now become a USD bond rate. You're done. Currencies affect just the risk-free rate. Don't go messing with your beta and your risk premium and all that other stuff. Currency is a risk-free rate problem. Just leave it in the risk-free rate. And if I told you Cemex gets half its revenues in the US and half in Mexico, you know what your answer would look like, right? You would then take a weighted average of the 4%, which is the US premium, and the 5.95%, which is the Mexican premium, to come up with the equity risk premium for Cemex as a company. Separate companies from countries. So if I gave you Vale and I gave you the Chinese risk premium, I've done it for a reason. It's because 40% of their revenues come from China. I want you to use it in coming up with the equity risk premium for your company. Yes?
So if they do half of the business in Mexico and the other half in the US, why do you evaluate risk-free rate only based on Mexico?
You have to pick a currency. I'm not saying I'm evaluating it based on Mexico. I'm evaluating it based on a currency, right? So I can use that currency for, if I do my cash flows in pesos, I can use the US dollar rate if I do my cash flows in dollars. I can take a Mexican project and do everything in dollars and use a dollar discount rate. I can take a US project, do everything in pesos. Currency is always a choice, separated. Don't think of it as a country, think of it as a currency, right? It's just a scaling mechanism. Any questions on this part of the quiz? So at this stage, we've covered the first two problems on the quiz. That covers about 60% of the grade of the quiz. And I told you yesterday in class, the third problem is where I'm going to find out whether you really get this stuff. Because the first two problems are purely mechanical. You can if you're good at algebra, you can work through the mechanical equations. The first two problems you're going to be done with. And I want you to get done with the first two problems by 20 minutes. And so put a timer, end of 10 minutes. In fact, if you're in 10 minutes still on problem one, you shouldn't be there. It's multiple choice. Don't sit there intellectualizing this whole thing. Pick a damn answer, move on, right? You want to be done with the second because the third problem would require you to use every ounce of your conceptual understanding. So when you think about the beta of a company, we already talked about this in class, it's a function of three things. What kind of business are you in? The more discretionary your product or service is, the higher your beta. How much fixed cost do you have? And how much you bought. So I'm going to take one example, and I'm going to use this as an example to kind of illustrate pretty much every conceivable twist you can ever have on problem 3. So this was from a couple of years ago, actually 10 years ago. Okay? You've been asked to estimate the levered beta. Let me pause right there. When I ask you to estimate the levered beta, that beta goes with the equity in the company, right? So basically I want a beta for the equity in the company. This company is in two businesses, food and tobacco. That's not such an odd combination. For a long time, tobacco, if you think about it, Philip Morris used to own Kraft. And that was their way of kind of insulating themselves against the rest of the world. So there are two businesses, tobacco and food. The tobacco subsidiary is estimated to be worth 15 billion. So what have I given you there? I've given you the value of the business. And that's important because you need that for your beta weighted averages. And the food subsidiary is worth 10 billion. The firm is a debt to equity ratio of 1. For every dollar of debt, it is a dollar of equity. My suggestion is whenever you have a problem like this, draw up that financial balance sheet. Remember the financial balance sheet, assets on one side, debt and equity on the other. Always start with that because it will keep you honest, it will keep you on track. So let's draw the financial balance sheet. On the asset side of the balance sheet, I have tobacco and food. See why I called it a financial balance sheet? This is not an accounting balance sheet. It's not book value. These are actual estimated market values. 15 plus 10. 25. Now do you see what the advantages of having a financial balance sheet? You know how many people, when I gave this quiz, got stuck on the fact that I didn't tell them how much debt and how much equity there was that I gave, that just a debt to equity ratio. They kept looking through the entire quiz for where's the dollar debt, where's the dollar equity? Why do you not need it? Because balance sheets have to balance. So if you know the asset side of the balance sheet is 25 billion, and I tell you for every dollar of debt you have a dollar of equity, you have $12.5 billion of debt and $12.5 billion of equity. So if you see missing pieces in your company, draw the financial balance sheet, because if there's only one missing piece, you can plug it in. So if I forget to give you debt, or I hold back. I won't forget, but if I hold back giving you debt, or I hold back giving you equity, go back to financial balance sheet, you're going to. So you ready? That's what the company looks like right now. You've also been given the following information on other companies in each of these two businesses. In this case, in the food business, the other companies in the business have an average beta of 0.92. Let me tell you up front so that you don't have this issue. If I want to give you an unlevered beta for anything, I will call it unlevered. So anytime you see the word just beta floating around, assume it is just a levered regression beta, because for me to do the unlevered beta, I have to clean up that beta. So if I want to give you an unlevered beta, I'll be specific and say this is the unlevered beta for the business. Here I've given you the levered beta for these two businesses. And I've also given you the debt to equity ratio for these two businesses. You can assume that all firms, as I said, have a 40% tax rate. So the first part of this problem is usually a status quo question. This is true across the quizzes. Status quo question in what sense? I want you to tell me what the beta for this company's equity is right now, given the structure. So somebody lead me through this process. What's the first thing I need to do? Yeah.
So the first thing you're going to do is you're going to unlever your betas.
Unlever the betas using what?
So using the average debt to equity ratio.
Why not the company's debt to equity ratio?
Because that doesn't break down each subsidiary.
Exactly. So first thing you need to do is take those betas by business and unlever those betas using the debt to equity ratio for the business. So that's what I did. I took the 0.92 for the tobacco business. I unlevered it using the 25% debt to equity ratio for other tobacco companies. For the food business. The 1.17 for the tobacco business, unlevered using the debt to equity ratio for the tobacco business. I got an unlevered beta of 0.8 for food and an unlevered beta of 0.9 for tobacco. I'm getting closer, right? The unlevered betas for the two businesses. Let me ask you a question, just as a twist. What if I'd given you a third piece of information on each of these sectors, where I said 10% of each tobacco company is cash and 10% of each food company is cash? So in other words, I gave you a levered beta, I gave you a debt to equity, and then a third column that said cash is 10% of the value of each of these businesses.
You have to clean up the unlevered betas. So
Okay.
Unlevered beta over 1 minus cash over fair value.
Okay, which in this case would be 1 minus 0.1. So first thing that's going to happen is if I do that, my unlevered betas are going to rise. So somebody tell me intuitively why they're rising. What are these betas? Those are the unlevered betas for? You want to try?
Yeah.
So tell me why.
Because the cash isn't risky, so therefore it rises because the rest of the business is what is the risky part.
It's a weighted average concept, right? So if you take these 0.8 and 0.9, what do I have? The beta, I have the unlevered beta for being a food company and an unlevered beta for being a tobacco company. And I'm saying, wait, 90% of every food company is food and 10% is cash. So basically what I'm doing is doing the same weighted average concept and saying, that must mean the tobacco business is a lot riskier than I thought, and the food business is riskier. So if I give you the debt to equity ratio, and the cash, that's a way to clean it up. Yeah.
So the mechanics for cleaning up for cash, would you unlever the beta given by the market average, and then do like a weighting? So using like risk like being 0 multiplied by the weight of cash.
Well, 0 multiplied. So what will happen is basically that unlevered beta here for the company will then be 0.9 times the unlevered beta for tobacco business plus 0.1 times 0 is 0.8. So basically what will happen is the 0 will drop out, right?
Yeah.
So all you'll be left with is your unlevered beta for the company divided by the proportion of the company that's not cash. So that's why you divide both those numbers by 0.9, you'd have the unlevered betas for tobacco and food. So if you get a chance again, and I reminded you about this in class yesterday, take a look at the email I sent out on Sunday, because the last section I take you through this process of what I do with cash and why it matters. Yeah?
Would you explain why it makes it riskier again? Just like
Because it's the beta for the whole company is 0.8, right? 10% of the company is cash. So what I'm asking is, what's the beta for the remaining 90%? Right? So because cash is pulling my beta down, if I take cash out of the picture, it'll push up the beta of the rest. So intuitively, that's all I'm doing. It's like looking at it. Think of Apple. Whenever you get confused about this, think of Apple as a company. What's the market cap of Apple as a company? It's about 600 billion. How much cash does it have? 225 billion. So when you see the beta for Apple as a company, even if it has no debt, what you see as a beta for Apple as a company is not a beta for the smartphone and the computer business, because 225 billion of Apple's 600 billion in value is riskless. So if you see a beta of 0.8 for Apple, don't be surprised that it's low, because almost 40% of your company is cash. Of course your beta as a company is going to be low. If you truly want a beta for Apple's real businesses, it's going to be much higher. Because if you take the cash out, think of how much riskier the company would be. That's all we're doing when we clean up for cash. So now I have a beta for tobacco and food. Here's what I'm going to do. I'm going to go back, and this is the nice thing about having a financial balance sheet. I can add layers to it. I added a column. So if you look at tobacco, tobacco's beta is 0.9, food's beta is 0.8. The unlevered beta for this company, not the equity yet, the unlevered beta for this company is a weighted average of those two betas, weighted by how much value I have in each. In this case, 15 billion comes from tobacco, 10 billion from food. So this company is 60% tobacco, 40% food. The weighted average is 0.864. So what's that? What am I going to call that? That's my unlevered beta for this company. So if this company had no debt, I'd be done, right? Because this would be the equity beta as well. But this company has debt. For every dollar of debt, it has a dollar of equity. So to get the levered beta, here's all I did. I brought in the debt to equity ratio, which is 100%. I took out the tax effect from the debt. And what I get as my levered beta reflects the fact that I've borrowed a ton of money in this company, and that's pushed the beta up from 0.864 to 1. So if I look at the beta of the equity in this company, it's going to be much riskier than the company overall, because I've chosen to borrow money. So my suggestion, whenever you have one of these problems, is always start with the assets out of the balance sheet and work out the unlevered beta first. Always do that before you turn to the debt to equity side. So always look at the assets side. What do I own? What are their betas? What's the weighted average? You got the unlevered beta for the company. Then bring in the effect of debt if you have any in the debt to equity ratio. You should be able to get a levered beta. Yes?
You take out the cash effect after you find the unlevered
Don't do the
beta?
cash. In this case, if there's cash, leave the cash in there.
Okay.
Right? Because in a sense, the cash belongs to the company. So if I ask you what's a levered beta for Apple as a company, let's say you got the smartphone beta and the computer beta and the cash beta. They're all assets on your balance sheet. So when you do the company's levered beta, you should leave cash in there because it comes to you with the company. The reason we took cash out was to get a pure play beta for their businesses.
So you don't actually need that to get cost effective?
You don't actually need what?
The unlevered beta for the business without cash.
Because the levered beta is all you need for the cost of equity, right?
Okay.
For the cost to capital, you need the unlevered beta without cash. So that's why we keep track of it, but for the cost of equity, you don't. Yep. Somebody back there had a question? No? You had a question? Go ahead.
Do a question. So cash is naturally included in equity, so you would need to subtract it out if...
Don't mix up asset with liability sides. Equity is on one side, cash on the other, right? So don't think of does equity. Equity includes a piece of everything you own as a business, including cash, right? So keep cash on the asset side, equity on the liability side. And we'll see in a minute why I'm going to do that. Because otherwise, all kinds of complications are going to arise when I start saying things like the company pays a dividend. Your head will start spinning if you start thinking about equity as including cash or not including cash. Equity is on the liability side, cash is on the asset side. Let the two stay separate. And treat each one for what it is. Cash is riskless, it lowers your unlevered beta. Equity, if you have it, affects your debt to equity ratio and affects your levered beta. Yes?
For this case, where do we get the risk-free rate and the risk-free?
It was given in the problem. I just cut a piece of the problem out. So you go back and look at the original quiz. It was actually given in the quiz.
And another question.
Yeah.
For this case, why do we have to separate the debt and equity? I thought we just need the ratio.
You could use the debt to equity. You're going to see in a minute, though, why you need the debt and equity for the second part of the problem. For the first part, you're right. I could have just stayed with 100% debt to equity ratio. The second part, I will need the dollar values. Ready? Now, let's create some messes and clean them up. So let's assume now. Yes, go ahead.
Sorry, from the previous slide,
Yep.
where did you get the 5.5?
That's remember pre-2002 I said I did not give the equity risk premium and yet look it up. This was a pre-2002 quiz, the 5.5% So if you were doing this today and I forgot to give you the equity risk premium, what would you use? The 4.54 or whatever you see in your notes as a historical premium. But in most cases, as I said, starting in 2002, I've been giving the mature market premium. Yes?
Sorry, if we have cash in this part, which is not in this.
You don't worry, it'll come in. So in a minute, I'm going to create the cash. So we'll talk about cash. It's going to be very easy to bring it into the process. Okay? So ready? Here's what we're going to do. Everybody comfortable so far? So now let's assume the company divests itself of the food business. Okay? What will happen to the beta vector? So let's take this a step at a time. What happens when you divest an asset? You sell it off, and what do you get in return? Cash. So now we have replaced one business, and that's the easiest way to think of cash. Don't think of it as some unique asset. Think of it as a cash business. So this company has gone out of the food business. It is now in the cash business. So if I ask you right after the divestiture, what will your levered beta be? Your debt and equity haven't changed. And now do you see why I don't want you to bring in debt and equity and cash? When you divest something, nothing has happened to either debt or equity. You've just replaced one asset with another. So when I compute my unlevered beta now, all that's going to be different is instead of using the food company beta, I'm going to use 0 as my beta because I'm in the cash business. My unlevered beta drops to 0.54. Why? The company's become safer because I've replaced the risky food business with the riskless cash business. My debt to equity ratio hasn't changed 1%. It's exactly what it was before. Until I do something with the cash, nothing has happened to debt or equity. So don't, I've seen people when you divest something start reducing equity. So what the hell are you doing? I divested something. Nothing's happened to equity yet. So right now, if you ask me what the levered beta is, it's 0.864. The debt to equity ratio stays the same, but the cash balance lowers the unlevered beta. So everybody with me so far? So now the company looks at the 10 billion in cash and says, hey, we don't need 10 billion in cash. So now let's start doing things with the cash and let's see what it does to your unlevered beta and the levered beta. So let's try taking the cash and paying off the debt. Can we do that? Sure, right? You got 10 billion in cash and 12.5 billion in debt. If I take the cash and pay off the debt, the cash of course goes to 0. My unlevered beta now becomes the beta for the tobacco business because that's all I've left. My equity stays 12.5 billion because I've not done anything to the equity, but because I've paid down my debt goes from 12.5 to 2.5. The advantage of a financial balance sheet is you can always tell you've done it right because the balances will still balance. The company's become smaller, the debt has dropped off. If you ask me what the levered beta is going to be, the unlevered beta is now 0.9 because the tobacco business is. The levered beta is now going to be 1.008 because the debt to equity ratio has gone from 100% down to 20%. So that's what would happen if I use the 10 billion to pay down debt. Everybody comfortable on that? Now let's try something else. What if I'd use the 10 billion to buy back stock instead of paying down debt? I'm allowed to do that. My unlevered beta will become the tobacco beta again because the cash has left the firm. But now instead of reducing debt, I'm going to reduce equity because when you buy back shares, here's what happens. The number of shares decreases. In this case, the equity goes to 2.5 billion. So what's going to be different here is my debt to equity ratio is going to be huge after this transaction. It's going to be almost 500%. And my levered beta is going to shoot through the roof. Why? Because I've reduced my debt by 10. Reduced my equity by 10 billion. So when I pay off debt, my debt went down. I buy back stock, my equity went down. Now let's make this even more messy. What if instead of doing either of those first two, I decide to pay a dividend of 2.5 billion and pay down debt by 7.5 billion? Now my business now it's still just a tobacco business, but my debt will drop from 12.5 to 5 because I've paid off $5 billion. $7.5 billion of debt, and my equity when I pay a dividend is going to decrease. Dividends and buybacks have exactly the same effect on equity. They make them smaller. My equity drops to 10 billion. My debt to equity ratio now is 50%. My levered beta is 1.17. So when I paid off debt, the debt went down, and I paid off. When I bought back stock, the equity went down, and I paid a dividend, equity goes down. Or let's load up the tray and make this really, really messy. What if I decide to buy a social media company for the technical question? Yeah?
For that last example, did they only have 10 million in cash?
Yeah?
So they used 5 billion to pay dividend, remaining 7.5?
No, they paid, yeah, 2.5. They paid 2.5 billion in dividend, not 5 billion.
Oh, 2.5, okay.
So let's assume they decide not to pay down debt and instead go out and buy a social media company for 10 million. You're allowed to do that. Let's assume the unlevered beta, and I usually give you the unlevered beta if you're entering a new business, is 1.8. That's what's going to happen to the company after the acquisition. You now replace cash with social media with an unlevered beta of 1.8. The unlevered beta of the company will be a weighted average of the 0.9 and the 1.8, which is 1.264. The debt and the equity haven't changed 1 cent. So if you divest a business and use it to buy another business with exactly the same cash, there's no new debt, no new equity. So the debt and equity stay the same. The levered beta is going to be 2.02 because you've entered a much riskier business. You can actually take this balance sheet, take every conceivable thing you can think of, acquisitions, debentures, special dividends, buybacks, because there are only so many things you can do as a company, and everything is going to be in this example somewhere. So ready, let's do one final example where I load up the tray and bring everything in. Let's assume I take the 10 million in cash, borrow an extra 5 million, and use 15 million, or billion, or whatever I am, 15 billion to buy a social media company. So now I have 15 billion in tobacco and 15 billion in social media. So my 50-50 weights, my unlevered beta is 1.35. But I also borrowed 5 billion, so my debt goes from 12.5 to 17.5, which means my debt to equity ratio has now gone up from 100% to 140%. My levered beta is going to reflect both the changing business and the changing debt to equity ratio. So in this problem, in this particular case, both the asset side and the liability side are changing because I borrowed money to do the acquisition, and that's changing the debt to equity ratio. So when you work through those problem trees, that's what you're looking for. Is don't make each problem an exercise separated from the previous one. Look for what you're doing in these problems. That's common because if you look at this, I'm moving things around, right? There's only so many things I can do in a company. And in fact, this actually lists every conceivable action you will see on any quiz. And what I'd like you to think about, and I'll send you the kind of the completed table when I get a chance, or probably this afternoon, is I've listed out a bunch of actions. And with each one, in fact, let's do this now because we have the time. Okay? So what I'm going to do is I'm going to list an action, and I'd like you to tell me how it's going to affect the asset side of your balance sheet, how it's going to affect your debt to equity ratio, and how it's going to affect the levered beta. Okay? So I'll give you an example of how this works. When you sell an asset, here's what happens. On the asset side of the balance sheet, you replace what you had as an asset with cash. Nothing happens to your debt to equity ratio. Your unlevered beta is going to decrease because you've now replaced a risky asset with cash. Nothing happens to your debt to equity ratio yet. And your levered beta is going to go down because your unlevered beta goes down, your debt to equity ratio stays the same, your levered beta has to go down. So let's try the second one. You buy an asset with cash that you have on the balance sheet. What's going to happen to you on the asset side? You replace a safe asset with a risky asset. What's going to happen to your unlevered beta? It's going to go up because you replaced a riskless asset with a risky asset. What's going to happen to your debt to equity ratio? Nothing. Why? Because you're using cash. And that's again the advantage of separating cash from equity, because you see people pushing up equity saying, I use cash, cash belongs to equity, therefore nothing's happened to equity. Debt to equity ratio stays unchanged. So what's going to happen to your levered beta? It's going to go up. So if I take cash on hand and buy a risky business, that's exactly what will follow. What if I buy an asset and I use either shares or an equity issue to buy the asset? So this is the case when you acquire a company and you issue shares. Let's go through piece by piece. what's going to happen on the asset side of the balance sheet? It'll actually become larger, right? I've added an asset that wasn't there before. Will it increase my unlevered beta or decrease my unlevered beta?
Depends on the beta.
It depends on what you started with. If you bought a safer business than your existing business mix, it'll actually lower your beta. If you bought a riskier business like the social media business, it'll push up the beta. So it depends. What will happen to your debt to equity ratio? It'll get lower because the debt stays the same and your equity jumps, right? Because you issued equity to fund this acquisition. So your debt to equity ratio goes down. What will happen to your levered beta? It depends on which effect dominates. So if your unlevered beta did not change and your debt to equity ratio went down, your levered beta will come down. So it depends on what effect dominates. You kind of get where we're going? So let's try the next one. Let's assume you buy a new asset with debt. So the assets out of the balance sheet exactly the same as before. It depends on whether the asset you bought was riskier or safer. Your unlevered beta depends on what that beta of the acquired asset was. What will happen to your debt to equity ratio though? It'll increase because you issued new debt. Your levered beta, again, depends on which effect dominates. Will probably go up because of the debt to equity effect. Okay, so let's take paying a dividend. First, before you answer that, you have to ask, when I pay a dividend, I had to pay with cash, right? So I should have been more specific. Paying a dividend with cash on hand can have a very different effect than paying a dividend with borrowed money. So let's do the first simple one. Let's say paying a dividend with cash on hand. What happens to the assets out of the balance sheet? Cash becomes smaller, right? Cash leaves the company, so the unlevered beta is going to go up because I've taken a safe asset out of the company. What happens to my debt to equity ratio? What happens when I pay a dividend? Equity decreases by the dividend. My debt to equity ratio therefore goes up. So my unlevered beta goes up. My debt to equity ratio goes up. My levered beta will always go up when I pay a dividend. Now do you see why if I'm lending money to a firm, I don't want them to pay dividends because it makes the company riskier. I don't want you to do that if I'm a lender. What if I paid a dividend with borrowed money? Then it gets really bad, right? Because then not only do I take safe asset out of the company, but now not only does my equity go down, but my debt pops up at the same time. So my debt to equity ratio goes up even more.
So your unlevered beta won't change in that case?
It will because in this case of issuing, if you borrow money, it won't change because then you're not using cash. So, but there the debt to equity ratio will go up more. And finally, if you retire debt, if you buy back stock, the effect is exactly the same as paying a dividend. So don't make it more than it has to be. If you retire debt, again, I have to tell you where did the cash come from. If I retire debt with cash on hand, here's what's going to happen. After I retired the debt, my unlevered beta will always go up because cash left the company. After I retire the debt, my debt to equity ratio will come down because I've made my debt a smaller number. The net effect will determine what happens to my levered beta. So what I'd suggest you do is take one of those quiz problems, once you get comfortable with this, and start asking what if questions. What if this? What if that? What if I bought back stock? What if I paid a dividend? What if I acquired another business? What if I divest a business? And after a while, you'll see that you crack the code. It's not complicated. It's very simple if you have that concept of a financial balance sheet. What gets people into trouble on these problems is you sometimes get entangled in what's an asset and what's a liability. The cash equity one is a classic entanglement. And where they say cash belongs to equity, therefore anything I do with cash must affect my equity, right? Not really. It's an asset side of the balance sheet. If I use cash to buy another asset, I'm doing nothing to it. Equity stays what it is. So try that out because it's easy to get kind of confused as you go through. Draw the financial balance sheet and make sure it works. Yeah.
So like for the previous example, when we use cash to pay off the debt, the levered beta actually goes up. Can you explain intuitively why?
When you use cash to pay off the debt, why does the levered beta go up? Because debt actually gave you the tax advantage and cash doesn't. Because with debt you got that 1 minus t. advantage. With cash, we didn't have the 1 minus T advantage. There's no tax advantage that comes from holding
Does
cash.
it also depends on what business sector that is left in the business?
It doesn't matter because basically all that's happening when I use cash to pay off debt is the businesses stay the same. All I've done is taken a zero beta asset and used it to pay off a zero beta liability. Right? So all that's happening is both sides a zero beta item leaves the balance sheet. The only difference is before the zero beta item on the liability side I got a 1 minus T attached on the cash side. Yes?
For buying an asset with a new stock or equity issue,
Yeah.
was that on the lever beta was based on the net effect?
Yes. It'll really, because if I, let's say I issue shares and I buy a cash business, or I could buy a social media business. You can think about buying businesses ranging from a beta of 0 to beta of 15, right? So until you tell me what you buy, it's impossible for me to tell you what the net effect on levered beta is.
So the unlevered beta would go up
If I, so tell me again what you're doing. You're,
buying an asset by issuing new stock.
the unlevered beta might go up, might go down, stay the same. Do you see why? Because all you're doing when you buy an asset is you're adding a third asset to two assets you already have, and depending on what the beta of the two assets already is, the third asset can reduce the beta, leave the beta unchanged, or push it up. The unlevered beta effect is unpredictable. The debt to equity effect is always predictable. Yes?
Back to what I asked just now, the debt thing.
Yeah.
So if by paying debt with cash, their beta actually goes up, will the firms be discouraged to pay back
Well,
debt?
you're probably better off with the tax advantage being what it is, to have 100 million in debt and 100 million in cash, than to have zero cash.
Oh, yeah.
Because it's the tax law,
But it
right?
looks bad on their beta.
Doesn't matter, you get a tax advantage to make up for it. How much cash does Apple have? 225 billion. How much cash, I'm sorry, how much debt does Apple have? It's about 75 billion. So why do they have 75 billion in debt and 225 billion? You're saying that's silly. Why don't they just pay off the 75 billion in debt? Because they get a tax advantage on the debt, which actually makes, so companies will do strange things like that if the tax laws encourage them to do it. Okay? So because that's exactly the problem that Apple has. It doesn't have cash to pay off the debt easily if it wanted to. But it doesn't want it. It actually keeps borrowing money while it has cash. Because to them the tax advantage kicks in. Yes?
Did you say that when you pay dividends using cash, that your equity decreases?
When you pay dividends, period, your equity always decreases.
Why?
What happens on the day the dividend gets paid? This is market value of equity. The day the dividend gets paid, what happens is called the ex-dividend day. What happens to the stock price?
Stock price.
Yeah, on the ex-dividend day. It has to fall, because if it doesn't, it's easy money, right? Because if tomorrow is an ex-dividend day and the price is not going to fall, what am I going to do? I'm going to buy the stock just before the ex-dividend day, collect the dividend, sell it at the end of the day, and I'll make a sure profit. So on the ex-dividend day, the price has to fall. Otherwise, people will just step in and make money hand over fist. So when I pay a dividend, what happens is the stock price drops, the market value of equity decreases, and that's what you see as equity. So this is the market value of equity. That's why it is. And even the book value of equity, it shows up, right? Because when you pay a dividend, what happens? You've got to reduce your book equity by the dividend paid. But market equity is actually much more direct. Yes?
What about the cash adjusted beta, like bottom up betas? Do they come into play in this, or are they like?
Well, how did I get the tobacco business and the food business beta? That's why they come into play, right? Because I need a beta for the tobacco business and the food business and the social media business. And the way I get them is by getting that cash adjusted beta from other companies in the business.
So it's like an industry, for this industry.
Exactly. It feeds in as our business betas. That's how we get the business betas. Yes?
In class, when you were giving us the...
Sorry, is that a phone speaking or is that somebody speaking? Okay. Yeah, go ahead.
In class, when you gave us the betas for different industries, you typically use the median. In this case, you use the average. You gave us both.
Then use them. I mean, it doesn't matter. I would never take points away for doing that. That would be just sloppy wording on my part. To make you pick between the average and the median is not a financial choice. It's a statistical choice. Yes?
Why does the ex-dividend day consider?
Because that's the day by which you have to buy a stock to collect the dividend. So if you buy the stock by the ex-dividend day, you collect the dividend. If you buy it after the ex-dividend day, you don't get the dividend. So that day becomes significant because if you want to collect the dividend, you just have to buy the stock before the ex-dividend day.
Okay, so you just use that as like the start.
That's the day where the dividend adjustment shows up in the price. Otherwise, people just buy just before the ex-dividend day, sell it 24 hours later and say, where's my dividend? Okay. Yes?
Does it matter if we use the compounding method or whether we just divide by 12 on the 6 month?
I'll let you get by without compounding. It's okay. Multiply by 12, divide by 12, multiply by 52, divide by 52. It doesn't freak me out. Yeah. Yes?
So to clean up for cash, it's the same as levering the beta. So we use the.
Wait. Cleaning up for cash is the same as levering the
I mean,
beta?
like, in a sense that we use the same cash to fair value of the median company. Not
Yeah, exactly.
That's what
If you stick with medians, stick with medians probably all the way through. Yeah. Just stay consistent.
So if you're trying to get the levered beta, as we did in this problem, you're assuming that the business betas for the separate businesses are already cash leveled.
They have to be, right?
So you have to actually do that if you're given cash in each business.
That's exactly right. That's why I do through the what if in there when I gave you the business numbers. So what if I gave you cash? You'd have to clean up for the cash. Okay, I will see you tomorrow at 3:30.
Take out the effect of cash, you get the unlevered beta of the business. Right? So if you think about our business,
I just need to practice more. I get it. Yeah, I've only done all
So it's like you can this was like everything else
so without any regression,
Oh, I know. They were all separate. I'm so sorry. I literally felt like I never
It's fine. I read the end part. I don't know why I never occurred to you. But I read the end part.
yeah, sure. But the beta of cash,
I just like, because I realized that literally
No, we're just undergraduate.
I wasn't reading the content. Yeah.
So now that I'm
gonna just read it now. Get it over with.
What I start with is expression beta. Yeah.
The most, I think it's hard for OGE, it's like the macro recovery of
This could get that because actually which is free cash.
So if you gave us like, you know, that like that, I'm getting unemployment. So I just automatically put that.
And there, round, thank you, Charlie.
Don't round too much.
Like, well, that's how like, okay, it's expensive. I had a guy offer to me.
Good. Just making this happen.
No, we just have to.
So if I took the color comes through, and I paid the dividend, this would become